sorry, Professor?
21C. 20 bracket 1 bracket C. To an accountant, 20 bracket 1 bracket C is the most tangible indicator that tax land is legal land, not accounting land. Because accountants all day long think of interest expense as an expense, therefore section 9 should say it's deductible. But actually in law land, interest is something on account of capital. Interest and the debt to which it relates are on account of capital. Capital meaning the same thing as fixed assets like buildings or land, etc., on account of capital. Therefore, since interest is on account of capital, Section 9, there's no place for interest expense in Section 9 because Section 9 is not about capital items, it's about the income therefrom. Capital items are different. Because Section 9 doesn't pick up interest expense, we actually need something extra in the Income Tax Act to allow us to deduct interest. It is 21C. And you may recall the preamble in 20 bracket 1 is there may be deducted to calculate income from business or property, interest expense. If not for this, 21C, we would not be able to deduct interest expense. Interest being, pardon me, interest being, so says common law, on account of capital. Very related to interest expense is costs of borrowing money. Cost of borrowing money. Please turn to 21E. Passing along the way, 3 straight pages of fine print jurisprudence on interest expense. Costs of incurring debt. So what happens is if my business needs a line of credit, the bank will come in and do their investigation and see if my business merits having a line of credit, and so on and so on. And often, like usually, charges an upfront fee to borrow money from them and then to pay them interest over time. It is not unusual for these fees to be more than $1 million on very large borrowing, for example, in respect of expansion into other countries and that type of thing. And you, the lawyers, who will be doing or reviewing the paperwork that goes with the debt, it'll be helpful if you know what the deductibility is, if any, of fees incurred to go into debt. The short answer is these amounts, since they also relate to debt, are on account of capital. So we need something, thank you 21E, to be able to deduct them. Without 21E, there would be no deduction for these items. So for example, on a $1 million fee, we get to amortize that. That is to claim it in small slices over 5 years. Where do I get the 5 years from? Moving my finger down the page from 21E down to about 3/4 of the way down, 20% of the expense can be deducted per year. Please turn in the textbook.
What about a leap year?
What about leap year?
Well, it says that proportion of 20% of the expense, that the number of the days in the year is 365.
Either you get hosed or you get a bonus, I forget. But if you can calculate for me what the difference is for a $1 million line of credit fee divided by 5 times 1 over 366. Yes?
$550.
How much?
$550 ish.
See, it would have cost you $1,000 to get an opinion on that.
Or a case of beer.
Or a case of beer. So that we might refer, I think the legal term is de minimis. Please turn in the textbook to page 140. That paragraph gives some really good examples of the type of costs we're talking about. The cost of registering a mortgage, appraisal fees for financing, selling commissions, finder's fee are all deductible over 5 years. I would also include in there the legal fees relating to the drafting and negotiation of such loan. This also applies to, for example, when a company goes public. The cost of going public, by which I mean getting listed on the stock exchange, are mind-blowingly high. So there are registration fees with securities agencies, there are stupendous legal fees, tax planning, securities law, et cetera, et cetera. And those costs are, can easily be 7 figures, sometimes 8. And those costs are also costs that are on account of capital, would not be deductible but for this, and therefore also deducted 1/5 per year. I have nothing else to say about the calculation of net income unless you have any questions. Hearing none, we'll now talk about the calculation of taxable income. So Section 3 and all of these, Section 9, 12, 18, 20 results in the calculation of net income for tax purposes. And then please go to page 40 in text. In the case of corporations, there are exactly 4 and only 4 adjustments to get us down to taxable income. And it is taxable income. It is the amount to which we apply whatever the rate is, 9%, 27%, 15 2/3%. Let me start with dividends from Canadian corporations. Under what subsection are dividends from Canadian corporations fully deductible? They're included in net income, but then we get a deduction to arrive at taxable income for Part 1, yes?
112, 71.
Yes, 112 bracket 1. Done. Charitable donations. Charitable donations are an expense in accounting terms, but the Income Tax Act has a restriction whereby we're only allowed to deduct a certain amount of charitable donations. It's based on our net income. It's 75%. So for example, if our net income is $1,000 and we make a $2,000 charitable donation, we're actually only allowed to deduct 75% of net income, thus $750, not the full $2,000. We're able to take the excess and deduct it over the next 4 years if we have enough net income in the next 4 years. So charitable donations are not fully deductible unless they don't exceed 75% of net income. When a company has $10 million of net income, usually that 75% limit doesn't come into effect because normally charitable donations are nowhere near 75% of net income. Any questions on that? Please turn the Income Tax Act to Section 111. Talk about losses. Let's go to 111.1A. Unused losses of other years. What this means is this, and I'm going to talk business losses for a second. Let's say that our net income in 2019 is minus 30. That is a loss. So our net income down to here is minus 30. So that's sort of Section 9 plus whatever other adjustments are made under 12, 18, 20, et cetera. Minus 30. And this is losses from business. Our loss from carrying on our business is minus 30. We can carry this loss back 3 years. So for example, if we had income in 2017, let's say 2017 we had income of 60, 2018 was 0. We can carry this 30 back to 60. That means telling CRA we essentially refile our 2017 tax return and say, hey, we told you our income was 60, but now we're deducting 30 against that. This is 60 for 2017. Now we're deducting 30 of losses against that. Please send us a refund. What CRA is happy to do, they will send us a refund for 2017. So these unused losses of other years means unused loss of 2019, which is an other year, in that we are measuring now the new 2017 taxable income. Okay with that?
I have a question.
Yes.
Is it beneficial to carry losses forward or to use them retroactively if possible?
Is it better to carry losses forward or to use them carrying back first? Any discussion? Yes?
I would imagine that carrying it back is better because you get that tax benefit now, and the time value of money says that my money now is better than mine.
I'm going to repeat that in case the camera didn't hear it. Better to carry back, because if we do that, we get the refund back now, as opposed to carrying it forward to, say, 2025 or something like that. I like that answer. Any others?
Wouldn't it also depend of like what stage your business is probably in? Like if you're expecting that your business is really going to ramp up in the next few years, you're going to want to save as many of those losses as you can to minimize the amount of income the amount of income you're going to have to pay.
So the question is, well, wouldn't it depend on sort of your prospects for the future? That is, if your business is going to ramp up and your income will be higher, wouldn't you be better off to use the losses against that later on? The answer is yes, but what's the tax rate in the future? Now, if your tax rate right now is only 9% and you're thinking that your tax rate in the future might be 27%, then yeah, I very much want to carry those losses forward. I know that I won't get the refund now. Hopefully I'll get it in 3 years, and I can do some math to say, well, what's better, a refund received now or a bigger refund in 3 years' time? You can do math, or the accountant can, to figure out sort of what is better. Then you can make an informed decision. You're giving up something which is certainty, but hey, maybe your prospects are in fact ironclad, and you will be doing better, and your tax rate will be higher. However, I can tell you that if your tax rate won't be higher, then all day long I'm taking my loss now, carrying it back. The other reason, besides cash consideration, better to have cash now rather than the future, is if I have losses in future years, and I'm carrying more losses forward, I might actually have a situation where some losses might drop off because, and here's the next point, we don't get to claim these losses forever. We don't get to claim them forever. These losses have a best before date. And if we have too many losses built up, it's possible that we might not be able to use all our losses if we don't have enough income in the future. Thus another reason to use losses earlier. Probably the rule of thumb is to use losses as soon as we can, unless we've got total confidence that we'll have enough income taxed at a higher rate than today's rate. Which, by the way, could sort of back into policy discussion. If we think that, generally speaking, corporate tax rates will be higher in the future, that might be another reason to hold on to the losses and not use them yet, use them in the future. But that one's got even less uncertainty to it than how well our business do. So, but anyway, that's a good discussion. Those are exactly the arguments that I would have made if I were considering this on behalf of the client.
Does that also work with the section of income that's not taxable under the small business deduction? So if you break that $500,000 barrier, all of a sudden now your loss is going to be refunded at a higher rate? That also?
Yes, our losses reduce our taxable income, which means that in a given year, if we have some taxable at 500 or at 9% and some taxable at 27%, our losses reduce to 27%, not the 9%. Like the losses don't get tagged with, oh, you have to deduct that against the small business deduction. They just reduce our taxable income. And if our taxable income is higher than 500, then that means that we're enjoying the losses at a high rate right now, which is awesome. Unless we think the high rate will increase in the future, but that's taking a bit of a gamble. 111.1A. For the purpose of computing the taxable income of a taxpayer for a taxation year, like alliteration, there may be deducted such portion as the taxpayer may claim. Taxpayer may claim, that means it's optional. This is why we don't have to claim it this year. If we want, we can carry it forward or not claim it. So anytime we have the word may, that means it's at the taxpayer's option. May claim of the taxpayer's non-capital losses. Non-capital losses is what we call losses from business or property. So any loss that's other than a capital loss is a non-capital loss. So these are from business or property. It is possible potentially to have a non-capital loss from employment, but I can tell you it's rare. And again, employment has nothing to do with corporations. Non-capital losses for the 20 years immediately preceding and the 3 taxation years immediately following. So you hang on, that seems backwards. Like we can carry back 3 years or forward 20, so now we're identifying the shelf life. They have a 20-year shelf life going forward. The wording sounds backwards, but we're talking about the 2017 taxation year. So if I read this again and you have in your mind 2017, not 2019. For the purpose of computing the taxable income for the 2017 taxation year, we may deduct non-capital losses for the 20 years immediately preceding. That is non-capital losses, business losses from 2007 carried forward. 1997, thank you, carried forward to 2017. And 3 taxation years immediately following 2017 which are 18, 19, and 20, we can carry back losses of those years to 2017. So the rule is we can carry back 3 and forward 20, and the actual statutory wording is a little bit in reverse, but understandably so, because the statute is referring to the year to which we want to carry the losses. In our example, 2017. That's why the wording is like it is. Any questions on that? The important thing here, which I'll ask you to do, is circle the number 20 and the number 3, which will signal to you that these losses are carried back 3 and forward 20. Non-capital losses, I got nothing else to say about those. Capital losses, 111 1B. So I have 2 capital transactions in the year. I have a gain of 100 and a loss of 80, and the taxable portion of that is 50 and 40. You okay with that? So obviously 1/2, 1/2. And the net here is 20. You okay so far? This is what's called an allowable capital loss.
Sorry, the net, is that net over all the years? Would that not be 30 for the net? Or is it 10 for the 1 year, or is it? Okay.
Here we go.
Thank you. Thank you. Our allowable capital loss is 40. We don't get any discretion about when to claim this loss because we have gains in the year. We're actually forced to claim the loss, the result of which is a net taxable capital gain of 10. Study. Now I'm going to change this, make a loss of $160. Which becomes an allowable capital loss of 80. But as you may know, we cannot claim more allowable capital loss than taxable capital gains that we have. Thus, what happens here is we get to claim 50 only. To reduce our net income from capital gains, taxable capital gains, to 0. And we have a 30 net capital loss. So allowable capital loss is the actual loss that we incurred in the year. And we're forced actually to deduct as much of that as we can against our other taxable capital gains. And then, having reduced this to 0, we have what's called the net capital loss of 30 that unfortunately we cannot use this year. We cannot claim a net capital loss against other sources of income. But we can carry it over to other years. The reason we cannot claim it against other sources of income is found on page 36. Because in section 3, it says that taxable capital gains, this subtotal must be positive or 0. That is, that we cannot claim a loss from capital losses against other sources of income. We can only use our allowable capital loss to reduce our taxable capital gains to 0. And then the result is that we have a net capital loss, which in our case here is 30, being 160 divided by 2 is 80 minus the 50 we use this year is 30. It's kind of crappy that we cannot use that 30 against other sources of income. But the Act cuts us some slack in 111(1)B and says that we can carry forward this 30, we can carry it back 3 years or forward forever. Only against taxable capital gains, though, of other years. So that's the language, the statutory language here is that in, again, let's say 2017, we can deduct net capital losses for taxation years immediately preceding, for taxation years preceding. So in 2017, that's capital losses from 1971, which is the birth of capital gains and losses, 1972. We can carry forward capital losses from 1972 to 2017. Or rather, the 3 taxation years immediately following being 2018, 2019, 2020. So the language for capital losses is similar to the language for non-capital losses, but we are allowed to claim losses from all preceding years. And another way of saying that is that we can carry forward capital losses, net capital losses forever. So this net capital losses is this net capital loss. For example, 30 that arose in our situation here from 2019. Thank you, and let's regroup at 3:05.